How does tail risk hedging affect portfolio performance? Have you ever wondered how investors protect themselves from sudden market crashes? Tail risk hedging is a strategy that plays a key role in this protection. It involves using financial instruments, particularly options, to safeguard a portfolio against rare but severe market downturns. These downturns, often referred to as tail events, can lead to significant losses that traditional models do not always predict accurately. When investors incorporate tail risk hedging into their portfolios, they aim to minimize the impact of these extreme losses. One common method is to buy out of the money put options on indexes. These options increase in value when the market falls sharply, acting like insurance for the underlying stock holdings. For instance, if you purchase put options on a broad market index, you can offset losses during significant market declines. The effect of tail risk hedging on portfolio performance can be seen in two main ways. First, it provides downside protection. During market crashes, these hedges can significantly reduce losses. This preservation of capital is vital, as it helps prevent a portfolio from spiraling down due to panic selling or systemic shocks. On the flip side, tail risk hedging comes with costs. Since tail risk events are infrequent, the options or strategies used for hedging may lose value or expire worthless in stable or rising markets. This consistent cost can drag down overall portfolio returns during years when the market is performing well. For example, funds that focus on tail risk hedging, such as those holding long-dated put options alongside safe assets like treasury bonds, often show negative returns over time because the market generally trends upward. From the perspective of stock trading and options, tail risk hedging requires a careful balance. Investors must weigh the cost of protection against the potential benefits of avoiding catastrophic losses. Strategies like purchasing out of the money puts or structured option spreads can help limit costs while still providing some defense. However, being too aggressive with hedging can erode returns in normal market conditions, while insufficient hedging leaves the portfolio exposed to severe drawdowns. In practical terms, tail risk hedging can improve the risk-adjusted performance of a portfolio. It reduces volatility and limits maximum drawdowns, which is especially important for investors who have a low tolerance for large losses. However, it is not intended to boost returns during typical market conditions and often acts as a drag on performance unless a tail event occurs. Tail risk hedging affects portfolio performance by providing a safety net against extreme market declines, but it also incurs regular costs that can reduce returns during stable market periods. To effectively use options in tail risk hedging, investors need to consider factors like strike prices, maturities, and the intensity of their hedging strategies to align with their risk tolerance and return goals.